All right, let's get right into it. Today we're diving into a really fascinating analysis of Nvidia, a company that's pretty much at the dead center of the entire AI universe. But here's the twist. Instead of just cheering on its incredible rise, this piece asks a really sharp question about whether this whole AI boom can keep going at this pace. Okay, let's do this. So just to set the stage, let this number sink in for a second. $4 trillion. Nvidia has become this absolute behemoth. I mean, they are, without question, the king of AI hardware, selling all the shovels in this massive digital gold rush. But, being on top of the world also means you've got the furthest to fall. And that really gets us to the heart of the matter. With Nvidia's next earnings report just around the corner, everyone is expecting another mind-blowing quarter. But the analysis we're digging into today suggests maybe we should be looking for something else, the first real signs that this incredible party might be about to get the bill. So let's unpack this central idea, this alternate thesis. The whole point here isn't to predict some huge, dramatic crash. No, it's arguing for something much, much more subtle, a different kind of correction. And look, the author makes this super clear. This isn't some Nvidia is doomed rant. Not at all. It's about taking a step back and having a reality check on all the challenges that are starting to pile up. Challenges that could get in the way of the perfect, non-stop growth that seems to be baked into the stock price right now. And this is just a brilliant metaphor for it all. Forget that loud, dramatic pop you imagine when a bubble bursts. Instead, I want you to think of the sound of air slowly leaking out of a tire. A hiss. And that hiss is being caused by some very real, very tangible pressures that are starting to build from all sides. So where exactly is this hissing sound coming from? Well, the source material points to a few different cracks that are starting to show up in the foundation. First up, the expectations are just out of this world. I mean, look at these numbers. A $4 trillion market cap is already staggering. But then you see the forward PE ratio, sitting around 40x. A number like that isn't just pricing in success. It's pricing in years of absolute, flawless perfection with literally zero room for error. Now, for a while, the engine of Nvidia's growth has been this massive spending from the hyperscalers, Google, Meta, and the like. They've been opening the fire hose, with spending maybe hitting the mid-$300 billion range. But here's the thing. That fire hose is also becoming a massive headache. You've got CFOs starting to ask some really tough questions about the return on investment and how fast this super expensive hardware becomes obsolete. And then you've got China, which the analysis calls a regulatory yo-yo. And that is the perfect way to describe it, right? It's just this constant back and forth of paused orders, licensing drama, and of course Beijing's big push to create its own domestic alternatives. It's a huge source of uncertainty. Okay, let's talk about the new Blackwell chips. By all accounts, it's an absolute marvel of engineering. But that marvel comes with a massive, and I mean massive, physical price tag that creates a whole new kind of problem. And here it is. This is the number that really matters. Each single rack of the new Blackwell system needs 120 kilowatts of power. Think about that. You're not just buying chips anymore. You're buying a huge liquid-cooled power and facilities problem that you have to solve before you can even flip the switch. Which brings us to this crucial point. The limiting factor is no longer just how many chips you can make in the factory, or the fab. The bottleneck is now the physical power grid itself. The demand for AI might be huge, but if you can't get the electricity to the data center, that demand just has to wait. On top of all these physical limits, we're seeing clear signals in the market itself. A year ago, you practically couldn't get your hands on an H100 chip to rent. Now, prices are falling. Some spot markets are seeing prices as low as $1 an hour. What that tells you, loud and clear, is that the supply-demand balance is really starting to shift. And finally, let's be real. Competition isn't just a theory anymore. It's here. AMD is now shipping a real cost-competitive alternative. Google keeps making its own chips, which keeps the pressure on. And for customers, the game plan is obvious. You find a second supplier, and you bargain hard on the total cost of everything. So, with all that context, how do we turn this into a practical tool? Well, the analysis gives us a great checklist for watching Nvidia's next earnings report, a way to separate the actual health of the company from all the hype. So, according to the source material, these are the 7 things that really matter. It's not just about the big headline revenue number anymore. It's about the little things. Does their guidance for the next quarter rocket up again, or does it just nudge up? What happens to their profit margins with these new, more complex Blackwell chips? Do they give us any clarity at all on China? And are we seeing demand from anyone other than the top 10 biggest companies? These are the real clues that'll tell us if the growth story is still pedal to the metal. So if this bubble does start to pop, what does that actually look like day to day? Well, again, this analysis argues it's not some sudden explosion. It's much quieter, much slower. It looks something like this. The guidance they give is still good. It's just fine, not insane like we've gotten used to. Their profit margins tick down just a little bit. The big customers start to slow their roll, matching their spending to the reality of getting power online. And those GPU rental prices, they just keep drifting a little lower. See? None of these are a disaster on their own, but when you put them all together, they slowly, quietly let the air out of that giant valuation.
Now, I know what you might be thinking. The big counterargument to all of this seems pretty obvious, right? Isn't the demand for AI basically infinite? I mean, every company on the planet wants in on this.
And the analysis has a really sharp answer for that. Demand is absolutely real. It's huge. But it is not infinite. It's bounded. It's limited by real-world constraints, by the amount of power you can actually get from the grid, by the budget a CFO is willing to approve, and, yeah, eventually, by the simple law of diminishing returns on your investment. And that leaves us with one final, really provocative question to think about. When you look at that $4 trillion price tag, what is the market actually paying for? Is it paying for Nvidia's incredible technology and amazing performance? Or is it paying for something that might just be impossible? The idea that this mind-bending growth can just keep accelerating forever without ever bumping up against the friction of the real world. And that, right there, is the multi-trillion-dollar question.